Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for this Monday, March 21st. Coming in this morning, my name is Ian Saunders, joined here by David Clark, and no shortage of movement throughout the broader markets over the course of the past week. Fortunately for most investors, it was a lot of upside movement, at least towards the latter part of last week. We saw the S&P, David, you and I were just talking, the S&P was up over 6% through the week last week. The Nasdaq 100 posted an even more significant gain, up over 8%. So a lot of indices, and a lot of those indices that have been kind of beaten up a little worse over the course of the past few months, showing a pretty significant push to the upside, which we'll get into more here in just a bit. We did see this lead to some indicator changes, which is where we're going to kick things off today. A lot of the different indicators have touched on. I mean, there's a lot of different relative strength and various other rankings that we have on the site, but we've seen some really interesting movement from some of the participation indicators, specifically first looking at that bullish percent for the S&P 500, which just simply takes the number of stocks, the percentage of stocks in the S&P 500 that are trading on a current point and figure buy signal. That number got all the way down to 32% with market movement through the end of February. So BPSPX, BPSPX, for those of you that are following along on the site. So we got down to 32% at the end of February, began to tick a little bit higher and kind of showed some back and forth movement there over the beginning of the month of March. Movement last week, though, led us to rise from that chart level down at 32 at the end of February. So the past couple of weeks, rising all the way up to 60%, rising over 8% in Fridays, based off Friday's trading data alone, all the way up to a chart level of 60%. So a rapid increase in the participation, that kind of intermediate term participation for the S&P 500, which at the end of the day is a healthy sign. It's a healthy sign to see markets, more names moving to buy signals is just a good thing. It's also a healthy sign to see this chart give a higher low. So we got down to 32% at the end of February. We did move higher, then reversed back lower and stopped out at 36% earlier this month before swinging higher last week, all the way up to that chart level of 60%. So definitely going to be important to note too that this is not the first time that we've seen 60% this year. The index, or the broader BPSPX indicator, when it rallied in February, it also reached that chart level of 60% before swinging lower towards the end of the month. So going to be an important thing to monitor. It looks like might be ticking a bit higher, at least at the time of this recording, with some major index gains on this Monday morning. But that 60% level is certainly pretty noteworthy, and good to see more than half the stocks trading on a buy signal. What we have not seen many changes on are many of the positive trend charts. And David's going to get into some more of the sector stuff here in just a sec, but looking at that broad PTSPX, so the percentage of stocks in the S&P that are trading in an overall positive trend, more of a longer term participation indicator, that as we touched on throughout this podcast over the last few weeks, that indicator got down to a chart level of 48% with this decline, kind of crossing beneath that 50% threshold. That's that kind of line of demarcation we tend to follow here at Dorsey Wright. And it has moved higher from a single day reading perspective, climbing up to 53.47 based off movement through Friday, which is not quite enough to get a reversal back up into a column of excess. It is good to have the single day reading, get back above that 50% threshold, but would ideally like to see a little bit more follow through to the upside. We may get that with the market movement this Monday. We may not. It may hopefully come later in the week if it does come, but that would be a real thing to keep an eye out there for. Seeing these kind of further follow through the upside on some of these positive trend charts is something that we've been looking out for on the index point of view, but also in that sector point of view there, David.
For sure. We're whether you're looking at the sectors or even just the broad market groups, the indicators have been very active over the past week, and that would, even just calling them active is a slight understatement, because we've seen such significant moves out of them over the past week. And looking at those broad sector indicators, we've seen 8 out of the 11 sector bullish percents reverse up with last week's action. So seeing some of the more offensive players move back and see that participation, increase. And notably, really the two sectors that you look at for offense and in many cases are going to be consumer cyclical, discretionary, and technology. And for consumer cyclical, we saw that bullish percent indicator increase from 20% matching its January low up to 34%. While for technology, we saw it really make a higher bottom there, as you sort of mentioned. It made a higher bottom there at 18 and has now moved up to 38, which is where we saw it sort of top out in February as well as in December of 2021. So in some of the cases for these indicators, we're seeing them match recent rally highs, if you will, to talk about indicators in that manner. So we're going to need some extra follow through for many stocks within these sectors to see them push through those levels. And that'll give us an extra layer of confidence. I mean, one of the things that I know in prior podcasts we've talked about has been looking for that confirmation, looking for the indexes to move back to buy signals, move the trends back to positive, and also see these indicators push higher and even clear some prior levels. And in some ways, we're right on the cusp of that. As we'll note here in a minute, we've seen the indexes move higher, and these indicators have continued to move higher as well. But the one that many cases I feel like we've gotten calls about last week is especially because energy had been such the leader in the clubhouse and carried the baton for much of this year. Last week, we could probably say wasn't its best week that we've seen, probably one of the worst weeks that we've seen in the year so far. But even looking at that bullish percent for energy right now, it's still sitting at 54%. And there's only one sector right now, and that's utilities, that has a higher reading, or even has a reading where it says over half the stocks in the universe still trade on point and figure buy signals. In some ways, we view this as still healthy because we saw so many of those energy positions get extended into highly overbought territory, and now they're taking that big exhale. In many cases, look for an exhale, maybe not one this big, but again, somewhat more healthy at the moment. We haven't seen enough downside action to really change any of the relative strength relationships, change the indicators enough so that we would look to be moving our exposure from energy at the moment. It still has that favorite area. It still is an area where you're seeing more participation than most sectors as far as looking at the bullish percents. And even when you move on to the longer term positive trend indicators, we see that those are still working like you were talking about in terms of the PT for SPX, they're still working on potential reversals into columns of X's. So again, we're seeing some of those trends move back to positive. And there's a couple that we can continue to watch. Really the two that I'm currently watching, and I know Ian's watching too, one of these is that PT for industrials as well as the PT for technology. Those two are within 1% of reversing up. Currently, the PT for industrials sits at 34%, while the PT for tech sits at 18%. And right now they're within 1% of reversing back up for the first time in many cases since reversing down in November of last year. So those are significant potential reversals that we may see out of two more potentially offensive minded sectors, if you will. So again, we've been talking about looking for that confirmation piece over the past couple of videos, podcasts, things like that. And I think in many ways we're beginning to see that, which is a positive sign.
Yeah, absolutely, David. And I mean, I think that interesting point. I mean, people don't normally think of industrials and technologies kind of moving in a simultaneous fashion, right? But I mean, I think that just speaks to that broad participation we saw last week. I mean, you're coming off the week where, as we touched on, the S&P was up over 6%. We had 4 consecutive 1% days, 1% positive days for the S&P for the first time since November of 2020. And we had another kind of interesting stat to throw out is that the S&P gained over 2% last Tuesday, the Tuesday and Wednesday of last week. It was the first time that we'd seen 2% days on 2% consecutive days for the S&P 500 since August of 2015. So even throughout the COVID lows, even throughout those massive upswinging days, in kind of the early April of 2020, I mean, you'd have the market up 5-6% a day, but then it was up 1% the next day. So we didn't see those consecutive 2% days for over 5-6 years at that point. So, I mean, a lot of interesting stuff going on in the market, and interesting stuff has not only been going on the domestic equity side of things. If we kind of shift gears to another equity picture, looking at the international equity space, I mean, international has been beaten up pretty bad, much worse than many areas in domestic equities throughout much of 2022 thus far. And China has really taken it on the chin the most. I mean, we've seen China be in a massive downtrend really since May of June of last year, with most of broad China moving significantly lower. And some positive commentary coming out of the Chinese government last week, kind of towards investor equity related commentary. I saw indices swing significantly to the upside, massive outperformance there from China, and specifically from China tech. Which led the broader emerging markets that looking at the iShares MSCI Emerging Markets ETF ticker EEM was up over 6% over the last 7 days of trading alone. It's still down 7% on a year-to-date basis, but I mean, big outperformance that you can see on that default chart there for EEM. And it fell through, broke multiple consecutive sell signals on that default chart, breaking its last sell signal at 45 earlier this month, and then falling all the way down to a chart low and pretty washed out position there at 41. Movement last week saw us rally all the way back up to that 45 price point where we sit currently. So still on a sell signal, still in a negative trend, but definitely could be an area to keep an eye out there for to see if we see some further follow through to the upside. More significant improvement was seen out of China, as I'd mentioned there. I mean, we've seen the broader China tech space looking at KWEB, the CraneShares China Internet ETF, is down 60% still over a trailing year basis. So over the past year, it's still down 60%. But last 7 days alone, it's up over 28%. And we saw it up over 38% in 1 day of trading last Wednesday. So massive outperformance that we're seeing there from, or massive rebound really from that oversold positioning there for KWEB. Going to be a pretty interesting point to monitor there. I mean, each of these areas are going to be still kind of in that overall negative trend. We did see KWEB move back to a buy signal, actually giving 2 consecutive buy signals with movement towards the latter part of last week. So definitely going to be interesting to notice if this is kind of a bottoming formation there for China tech, which has been beaten up much worse in many areas in domestic technology. So starting to see that improvement, not just from the domestic side of things, but also from the international side of things. But really, no matter how you cut it, until, as David was saying, until we see this confirmation, this kind of near-term rally, this pop that we're seeing from a lot of equity names kind of turn into that longer-term participation, that longer-term confirmation is really what we're going to be waiting for there. So with that, I mean, I think, David, that wraps up most of what we were looking to cover this morning, unless you had anything else.
Yeah, definitely. Again, like you said, looking for the confirmation piece, something that we've touched on quite a bit here. We're beginning to see some of those things, but truly, before we can begin to dive back in, it's waiting for that confirmation. It's hard to do sometimes, especially when you're watching, like you said, the market gained 2% in consecutive days, having a bit of FOMO, that fear of missing out. But really, it's much more prudent to look for the confirmation and almost sort of sit on your hands and say, I'm going to wait for these things to happen before I really dive back in and begin to move money back in, because it's been such a volatile year already. And that really, the first 3.5 months here can be defined simply by that volatility piece. And with a lot of these movements, it's still looking for additional pieces to give us confidence that we're moving back in. So hang in there. That's all we can say. And at the same time, we'll be here to answer any questions if you have any.
Yeah, absolutely. Like David said, I mean, we'll certainly be here for those that are subscribers. Want to give us a call? I mean, more than happy to help you out on that front. And we'll also be going through our broader kind of market update call on that we do on Wednesdays. So we'll keep you up to date in the daily report. We'll keep you up to date with any other kind of media stuff. And do want to give a quick shout out as well for those that are looking to get back into some traveling. We are doing an in-person event in Las Vegas and later in May of this year. So if you're looking for us to keep you updated in person, we can certainly do that as well. We have not opened up signups, but we're doing our spring symposium May 19th and 20th. It's going to be in Las Vegas. So signups are going to be coming out in the next week or so. So keep an eye out for that in the daily equity report or in any kind of email communication. We'll be sure to get that out. But if you have any questions on that front or on anything at all, you're always more than welcome to reach out to us at dwa@dorseywright.com. bullishercap.com or at 804-320-8511. So, David, thank you for joining us. Great to be back on here with you. And thank you to everyone listening in, and we look forward to having you back next week.